Okay guys, what's going on? This is Ryan, aka Cantering Clark, and it is 3:40 p.m. on March 19th. That is Thursday, and we have a few things to talk about. And before we get into the video, I just want to remind you guys that as long as you are a subscriber to the channel, if you leave a comment below, you'll be entered in automatically to win $100 in Bitcoin. And this is not a contest, all right? So it's not contingent on any particular comment. It's just a lottery, and all we ask is that you participate. So I'm going to try to keep this as brief as possible. I want to talk about a few things. Obviously, with everything that's going on, we're going to touch on what's going on in traditional markets. So I want to talk about Bitcoin and the indices, all right, specifically the S&P 500. A lot of the time on Twitter lately, you're going to see that I'm referring to the E-mini chart, so the ES chart. Those are the E-mini futures. So we're going to talk about Bitcoin in general, all right, trading it right now, things that we have to consider. And then I want to touch on gold. All right, so a lot is going on right now in traditional markets, and we've seen that over the last few weeks that Bitcoin has behaved more like a risk-on asset than a risk-off asset. And during periods of heightened volatility, when you have an overall deleveraging in markets, then risk-on assets are going to suffer. Now, ideally, we wanted to see, as we said that this would be its destiny to manifest, we wanted to see that Bitcoin was going to be that store of value, is going to be that haven or risk-off asset. But when you have asset managers that have allocations in Bitcoin and allocations in traditional assets, right, the order of operations is to take money or capital out of risk-on assets and protect your more vested or interested positions. All right, so you see that all correlations go to one, and we saw this in gold, we saw this in Bitcoin, and temporarily it looks like it has at least found some type of floor. All right, so I mentioned that there'd be a few things that I'd be paying attention to. Now, if we're talking about the correlations, all right, if you are a statistician and you're talking about Bitcoin correlated to the Bitcoin being correlated to the S&P, you're likely going to say that a 2-week interval of time or a 1-month interval of time is not enough to consider this maintaining any type of obviously long-term correlation. But we're not talking about long-term. We're talking about something that is an anomalous event. It's a black swan, right? And very much so, we've seen that when the markets are going risk off, and we see that the traditional markets are essentially dumping, Bitcoin is moving pretty much lock and step with the S&P, or when the S&P is not trading, we're looking at the ES. So when the ES or the S&P, all right, or traditional markets, and I'm just referring to that indices because that's one of the most popular ones to represent market confidence and sentiment as a whole, as well as strength or weakness. When the S&P is moving sideways or is beginning to put in some type of movement north, then I said that Bitcoin would likely, quote unquote, have permission to do so as well. So right now, the S&P is at, well, we're looking at the E-mini, and this is on, again, if you're using TradingView, you're going to have a delay unless you pay for that package. I don't chart the futures off of TradingView. I have a separate platform to trade futures off of. But if you're looking at the ES, right now it looks to, and we could just go to the S&P because the market is still open, it looks like it is essentially finding some type of base in the short term, right? So we're seeing a level of responsiveness, and whether or not that's due to some developments as far as the coronavirus goes, maybe the fact that we talked, or the president came out and said that he would release restrictions on being able to further development of a particular treatment. We're going to see that the market is going to rally, right? It's going to rally very strongly at some point, right? It's always a matter of when. So timing this is obviously where you make the money. It's not a matter of if, right? So we know that at some point the market is going to become crowded, and we will see a large rally to the upside. In 2008, we had a major move down that ultimately resulted in a move of over 50%. But on the way down, we had more than one or two rallies, 20% to the upside, particularly talking about October 2008. So right now we're just waiting for that to happen. Okay, and you can see that, as I said before, it's kind of like when the cat's away, the mice can play. When the S&P 500 is not just continuously falling off of one precipice after another, we're seeing that Bitcoin more or less has time to begin to put in some type of positive price action. And that's just as of recently. And for all BlockRoots members, we shared the trade from the break of balance up to 6,400. And that's exactly where we hit, or we hit just a few dollars above that. But that was the first area, the first sticky point that we had to consider. And, just because there's this whole gap in between up to 72, 73, does not immediately just open up that upside, right? We have to consider where greater market structure is. But as far as this correlation right now, what we're looking for is for the S&P or traditional markets to relatively cool off so that we could see maybe a shift back into Bitcoin in particular. I wouldn't say that, and it's not just a matter of this being cause and effect, right? Of just, equities are going to be, we're going to see risk on in equities, and then Bitcoin is going to be risk on again as well. This is a very temporary idea, right? So this is a very temporary environment that we're talking about. So Bitcoin is putting in a move to the upside, but I would not just go so far as saying that, we're going to be, again, approaching anything further than where we actually have just stalled from. So I'm still looking for shorts. All right, I'd say that this decoupling is temporary, and it's only because, again, when the cat's away, the mice can play, right? So this risk-off asset in particular, I think the one thing that benefits Bitcoin is that it is so small. All right, it is so small. It has such a retail presence compared to other assets that are structurally long. When you have asset managers in particular that are structurally long equities, and when you're in a period where volatility was, asset managers were short volatility because everything was just good, right? And you have asset managers pretty much being happy to write any type of position to the downside, right? On the assumption that we weren't going to be putting any type of major outside of the norm moves in any time soon. But, that time came, and you have all those asset managers that are structurally long, and it just builds in further downside, right? And we'll get into how that works in a further video. But so we see that the break-in correlation is temporary. Okay, there is a temporary break or temporary decoupling. So you're going to see that talked about a lot on Twitter. If the S&P starts moving off a cliff again, then I'd say that you're going to see Bitcoin follow it. Absolutely. And that's why I said on March 15th or 16th that the S&P did not bottom yet, so then Bitcoin did not as well. The S&P since that date actually put in a lower low. Bitcoin had not, but did move down again considerably. All right, so it remains to be seen. I would not just imagine that this is going to suddenly move all the way back up to where it left off, right? Where it dropped from. So if we're looking at areas right now that I am mapping out, all right, and now we'll just get into talking about Bitcoin specifically. Okay, I'm not considering the lower time frame levels as much as I might have previously. Okay, before breaking this greater market structure. So first things first, always indicating where those major turning points are. Okay, those areas that bring in everybody, all right, at once. We talk about major swing points on the daily and the weekly being areas that bring in a ton of participation. All right, so whether you're a position trader, a short-term trader, these are just areas that are going to get everyone's attention. All right, everyone has a vested interest before this breaking in this area. Okay, this was an area that we were pretty much putting all of our confidence in as being a low that we would ultimately leave from. Okay, and hopefully this would have been an anchor point for, or rather not hopefully, but as you can imagine, this was likely an anchor point, at least visually. Immediately, this is something that draws your attention as to be one of the first areas where we might expect longer term positions to have stops placed around. Okay, anyone who's new into this asset, as this being in, quote unquote, oh shit zone, right? So once we break this becomes the most important area, in my opinion, for us to retake. And that's why you cannot just consider that we're looking at closing a gap right here. So more often than not, when I'm looking at something that structurally looks like this, okay, if I'm looking at my TPO chart and this is a double distribution, basically an area that starts off of pretty low confidence, low conviction, looks like it's balanced, right? So it looks like it's going to start forming some type of value area, and then you have a very swift move in one direction. And in that move, you have this single print structure, no volume, no time, and then you form a new value area, and you form basically a new balanced area. And the trade setup is when you build a new area of balance within this structure. So if we're looking at this on the daily, and this was the trade that set up, when we build a composite of this bounce, all right, so an area that is kind of building a range, not necessarily as clean structurally, all right, and I'm going to get to why that is, but it is building an area based on time and volume distribution, all right, that is resembling somewhat of a balanced area. Now, normally when you break from some type of balance like this, okay, if you don't have, all right, in this case, which we do, a major structural area between, you're looking to cover this area. All right, so you're looking to cover the space in between where that gap existed. Right, and this is just one of the types of gaps that you're going to hear about. And it's not just gaps in the CME or gaps in overnight when we're talking about traditional assets. Gaps just where there is basically no transactions that took place, where there was barely any trading, where we moved from pretty much point A to point B and didn't do anything in between. So you're looking at a major candle like this, and it's pretty devoid of volume or participation. So again, normally we're going to look for this type of trade to cover ground, all right, from the beginning of the single prints. All right, so March 9th single print high in this case, the single print's right here. All right, to the next area where the volume begins to pick up again. But in this case, we actually have a major structure in between. So the trade we set up in the trade that we set up and talked about in BlockRoots was to this first sticky area. And I said, don't consider anything more than that, because at that point you're not taking into account the major change that has occurred, right? You're just kind of hoping that in a very formulaic way, we're going to move from the bottom of a gap to the top as we would if we were in good conditions. All right, so things I would say to consider, again, are the areas where we are distributing through, all right, looking for these balanced areas, and that's how I derive this composite value area low, this composite value area high. And if you're not using a TPO chart, again, if you're not using XO, if you're not using any one of these more sophisticated platforms, you can use just a fixed range. Take this, and you'll see that relatively this area was pretty balanced. Okay, so what you're looking for in any type of balanced range is you're looking for that break from balance. Okay, so we're always looking for at certain levels, all right, whether you're using distributions, okay, whether you're using value areas, whether you're using strictly defined structural ranges. What you're looking for is either absorption at certain levels, okay, or exhaustion or acceptance through. So when you have a really defined range, okay, and you're beginning to taper off in volatility and you're beginning to compress, you're going to be looking or observing the extremes. Okay, again, the middle area is an area you can get involved, but it's just that the middle of a range, when you're balanced, is more or less considered fair value. So why should it be said that price is likely to move up or down from fair value versus if it goes up away from fair value or down away from fair value and then returned, right? You'd expect if something dropped in value, if the market to chase up that opportunity, and if something exceeds value, that it would be sold, right? Because it would be sort of away from the average. So what we look for at the extremes is we'd look for either absorption. Okay, in this case, we would look for that aggressive selling to be maintained. So we would see that, for example, or at the highs, for example, we would see that, I think I just said, for example, probably 3 times in a row. We would look for aggressive buying. So you'd look for, in this case, some type of CVD divergence, whether or not that was something in the form of this, right? You're looking at a large chart like this and you're looking at CVD. And you're looking for, again, that sign that although price action is progressing, or rather although CVD is progressing, okay, that price action is not. So a divergence in this case in CVD would look something like this. You have your CVD continuing up through the high, but price is more or less range bound. So there's a ton of aggressive buying. If you're looking at a footprint, you're going to see that delta is showing aggressive buying, right, on the footprint with no follow through by that participation. So you'll look for something like aggressive buying, okay, price to be range bound still, and then a shift in participation. And ideally, you'd capture all those aggressive buyers up here, and then as you move the price back down, right, they would be trapped, and that shift in participation would be a shift from a very positive delta through this area. So if we're using this as our anchor point, okay, we're going to say that if we pass back through here, we'd want to see that relative volume is much higher. But for that relative volume increase, price is unable to maintain that move upward, and now we've fallen back below. And now you have an idea that maybe someone is trapped over here, and then you have to think about people being in pain, right? So people being underwater, being in pain. So either we're looking for that absorption in that case, or we're looking for something like exhaustion, right? So when you come up through a major area or major level, or however you want to delineate it, or what jargon you use, when you come up to this area, you're going to look for that shift in participation. And what that means is maybe you're looking at something like a footprint chart. So if we went on to XO, or if we go on to For example, if we go onto Sierra charts and we're looking at a shift in participation, maybe towards the highs, what we'd be looking for is, for example, if we're looking at this, and this delta chart is showing that, it is doing a good job, rather, of still maintaining that support on retesting. But you would want to see that as we come up, the buying is kind of falling off. We're not seeing a ton of volume at the highs, right? We're not seeing really any kind of aggression past a certain point. So you would want, ideally, for acceptance, if you're going to see that acceptance is occurring, you want to see that as you break through a level, the volume comes into the market, right? If it's being accepted at that new level, right? So just think about it. It's that dual auction. Now, the opposite, that exhaustion, is when you come through a level, momentum begins to shift, begins to decline in this case, towards this high, and we don't see that there's any more follow through in delta. So pay attention to delta, pay attention to volume. Obviously, when we have higher prices, you want to see that it brings more buyers into the market. So this is worth paying attention to right now. We've hit our target of 6,400. Ideally, you'd want to see that now this is being aggressively sold, right? So if we're looking at the fact that, now we're basically above this range, by all means, okay, we're above a previous swing high, right? Microstructure swing high. Now you'd want to see that this is aggressively being sold and maintained, because that same argument is made from the other side, right? This is being aggressively sold now, it's maintaining this structure, and you're building a base. And so now when we see a shift in participation, so if we see that, for example, we go from that aggressive selling period, so let's just look at this again. So if we see that these lows are aggressively sold, they're aggressively sold, and now we see that we have a shift in participation, positive delta. We're really seeing, if you're just paying attention to gradient and color, that we're not getting that negative delta. So the negative delta is coloring these distributions red, and we're just seeing blue come into the market. It could be green depending on what your setting is. And that shift in participation is showing us that buyers are taking over control, and that hopefully we have those aggressive sellers left behind, and the support has acted as support, right? So at a very atomized level, we are seeing that the support is holding, and it is holding in the face of very heavy selling. And this is why I will designate I will not just have every volume shown, I'll have a threshold. So I want to see when millions are coming in one direction or another, and that it is holding up in the face of that. And I don't care about 50,000 contract sell orders coming into an area and it holding, even though that might be a negative delta. So it might show that there was more selling in that area than buying, but still it's a very low volume. It doesn't really mean anything. So volume and delta, really important to pay attention to. Right now, also something very important to pay attention to is that BitMEX is no longer leading the market. All right. If we just look at BitMEX right now, it has become a ghost town since this drop-off. So this is Trading Light. I have no affiliation with them whatsoever. But this is, for example, a heat map. All right, and you have this on Tensor charts as well. I just opened this one up. Someone in the group gave me one of the access codes to this. And, this shows, again, where you have that resting liquidity. All right, and this is what I talk about when I talk about pre-transacted order flow, and it's not something that is as useful. I think that if you're looking at footprints, if you're looking at active order flow, if you're looking at aggressive order flow, looking at this can probably cloud your judgment, because what you're looking at is pre-transacted order flow. It's the advertisement, right? So it says hit me, it says I'm here, but we haven't really seen if it actually stood up to the test. We don't know what's going to happen when price comes to it. Over time you might see that these very large orders act as support and resistance, but I think as a whole what you're seeing is that overall that participation, even if it's pre-transacted, has majorly changed, right? So even at this setting, you see that prior there's a whole lot of resting liquidity when it came to prices that were very close to current market price, whereas right now it pretty much just had liquidity evaporate. And that brings me into another point, okay? So one thing that we have to talk about, and we talked about how we pay attention to distributions of price and volume and how we're looking for balance and not exactly just structures, is how these levels are not necessarily as trade-worthy as they would be prior in more liquid conditions. Okay, so during periods of higher volatility, okay, higher volatility just being a function of lower liquidity, right? It takes less to move more. Or even less to move the same as it would have prior, right? The idea is that there's low liquidity, it takes less capital to move from point A to point B now. So because of that, all right, because of the lower liquidity, we're seeing that levels are not really holding up to be what they would expect, rather holding up to what we would expect them to in previous conditions. So don't expect levels to hold, expect them to nuke. right? Expect levels to be broken through. And if anything, there is an edge in pushing levels when you have traders that are committing prior to those levels being tested, and they're committing on the assumption that they will hold up as some form of support and resistance, right? In these conditions, do not expect that to occur. In this kind of condition, I would be paying attention to levels and how the volatility is coming into those levels. And I would really need to be seeing more acceptance in this case, or more confirmation of the idea that I think that is trade-worthy, versus being the first guy in the boat. Okay, I don't want to be the first guy in the boat at this point. I want to see that the market is moving, and I'm going to be trying to, moving according to my plan, right? Not imposing my will on it whatsoever. But if I'm looking at a support, I need to see that it's acting as support. I'm not just stepping in the way of it unless it's a major, daily swing or weekly swing. I'm not blindly trying to play one of these patterns where I'm putting a, limit order in there in anticipation of mean reversion. All right. And in these kind of conditions, it's just really easy for price to skip $300, $400, $500 past your entry, and you just be completely royally, for lack of better words, fucked. So take on less risk, right? So take on less risk. Okay, I think that this is prudent advice that would not get anyone in trouble. Take on less risk, right? That means smaller position sizes to account for this slippage and this volatility, because that's the conditions of the current auctioning environment. You have to tailor your method to the environment that you're dealing in. All right. Otherwise, trading is difficult in and of itself on its own without any kind of change like we've had. Yes, we're getting a lot of movement, but that movement is the result of that volatility is the result of lower liquidity. Okay, so if we had this movement and the market was a bit more liquid, right, that'd be fantastic, but that would mean we'd have a lot more participation, because when you have more liquidity, it just means that the market has more friction. Okay, so if you're trading treasuries, you're in a very sticky environment. If you're trading the S&P, less than that, somewhere in between the S&P, somewhere in between treasuries is, the S&P, the DAC, and then crude oil. And then I'd say Bitcoin is more like crude oil, if anything, which makes it fun to trade because there is that momentum and that follow through. So expect lower levels to break, lower time frame levels, take on less overall risk. That means reduce your position sizes. You just have to do this, otherwise you're just asking to get beat up. All right, and again, look for absorption and exhaustion at certain levels. All right, pay attention to speed. Okay, pay attention to speed and volatility when price comes into your level. So you don't want to, again, just step in blindly at a level. Make sure that the market is pausing and beginning to allow you or beginning to form some type of structure so that you can at least cleanly define your risk. Okay, so if I'm looking at this right now and I'm saying, I expected that this would potentially be a deviation above this structure, and I'm looking to short any type of rally, well then still, I'm not just taking this short blind right now. I want to see that, for example, we put in some type of structure up here, some type of consolidation that shows that buyers are still trying to aggressively bid this, rather not bid this, but lift the offer, and too much of their efforts are yielding no kind of, let me rephrase that was terrible. Their efforts are yielding no movement. So that aggressive buying is being absorbed here. The heavier hand is in the passive order. And then from a breakdown, I'll be looking to buy, rather sell, the type of rally that we get post breakdown. So if we're looking at a consolidation here and then we get maybe a breakdown, I'll be looking to sell the rally that we get, because at least at that point I can define my risk and say, well, I'm wrong if we're back above that point, because maybe at that point, right? So your stop, first and foremost, your risk reward, your stop cannot just be something you manufacture out of thin air. All right. So I need to be able to say, okay, I want this price. If I think that this deviation is going to be moving down, price should not be back up here, right? Because maybe that point brings in that gap into play. All right, so maybe at that point, yeah, then the next area of business is this next area, which is structurally based. And if we're back above here, well, then I'm looking at this next sticky area. Okay, then my short is invalidated. So that's why I like to see some type of structure built, at least right here, because I'm not just entering in short. All right, price can do this many times over. All right, it could do this, and it could continue, go back and forth, and it's going to be very difficult to hold on to that trade when it's doing that, at least emotionally. I'd rather at least see this put in and then see it broke down, so I know, well, then if we're back above here, then maybe I am completely wrong, right? And, of course, you do run the risk of trapping anyone who sells this point right down here, of trapping them and then moving back up. But at least I'm seeing that the idea that I have is somewhat being manifested on the activity we're observing. Okay, keep in mind, right now is a extremely difficult time to trade. It's an exciting time, but it has to really dictate your approach. Okay, because it's very easy to be on the wrong side of the market in these conditions. So another thing that I wanted to talk about was gold. Okay, and Josh and I, we partnered with Phemex. Okay, we are working directly with Phemex. I have the utmost confidence in the exchange, and they listed gold, which I think is an absolutely fantastic thing. The fact that they're going to be listing traditional assets is huge, and we're looking at the test net right now. So by all means, sign up for this platform. The link is below, and try the testnet out first. Now, the fantastic thing about gold is that I think that when the market begins to settle again, all right, when even traditional assets, even traditional equity indices begin to settle, I think that we're going to see gold start to get bid up again, all right? Because gold is going to be bid up, all right, because gold was primarily sold off due to the fact that it was due to leverage reasons, right? So leveraging reasons, liquidity reasons, all right, such being that there was a lack of liquidity on the part of asset managers. They needed to sell their gold positions, all right, to make sure that they weren't margin called in other traditional assets and other traditional portfolio positions, all right, not haven positions, but more risk on positions. So I think that gold is going to be recovering, okay, at least when we put in some type of bottom. I think it's going to be putting in a stronger recovery. It has been something that is very formulaic to trade over the last few months. All right, so if we just look at the way that gold has traded in this higher time frame range from 2013 to 2019, this breakout, very technical breakout, technical retest, even on the lower time frames, we're seeing that gold has again put in these very clean structures. All right, and when you're trading and you're trading technically, the best thing that you could ask for is just clean structures, because if anything, the use of technical analysis is not to be prescriptive or predictive rather, but it is to be, again, descriptive. All right, we're at least able to describe what we see, and if that didn't sound clear, we're able to, if anything, define our risk a little bit easier when we have these clean structures. I finally got to what I meant to say after that word salad. But at least we're able to define our risk a little bit better when we have these clean structures in place. Okay, again, on BlockRoots, we talked about how we had a very clean structural shift right here, right? So we see that, for example, price is putting in these series of lower highs, lower lows, and for the first time, we're back above a previous support and resistance flip. Now, the thing that we talked about was for this to potentially resolve the way that this did over here on the lower time frames. So we had sort of this microstructure case over here as we had right here. Okay, so just looking at this pattern, you look at the fact that we're back above what is a microstructural high. Okay, again, a place of consolidation. And we were looking at this pattern over here saying at least if we're getting long here, we know that we want to be out of the trade if we're back within this range. And sure enough, this trade did not resolve positively. It ended up breaking down just the way that this did over here, but obviously with less follow through. And the fact that this asset, which is a risk off asset to begin with, is looking like it is putting in a potential bottom, makes me a lot more confident for gold in the short term, in the intermediate term, and I'm talking about in the next 2 months. Okay, I think that over the next 3 months, we're going to see that the market is going to be struggling, but I think anywhere from 6 months to a year, we're going to see positive action in all markets. And I think that Bitcoin is going to recover faster than anything else, just because it is such a low float asset. It is retail dominated, and I don't think that people that have stakes in Bitcoin have serious stakes like there are structurally in place with traditional assets. So when we're talking about traditional assets, we're talking about things that are woven into 401ks, retirement plans, things that are have an important place in the livelihood of families across the globe. Okay, and I say families because when you're talking about people that, mothers and fathers that have pensions, and they're thinking about their children, they're thinking about their unit, right? They're thinking about their family, and they're making these decisions based on that. So I think that when we see the market begin to cool off, that we're going to see gold begin to put in some really positive price action. I think that in the very short term, it'll be a buy. I'm going to start looking for these structural flips to begin with. Okay, so we have microstructure beginning to form. Again, something like this down here. Okay, what you're looking for is, you see an area where the market was rejected, and just very simply put, right? You see an area where the market was rejected cleanly. What is a positive change from that? Well, positive change might mean coming down here, but what we're looking for is to at least retake some ground on the lower time frames. Okay, and you see gold, you see the E-mini, and again, remember, these are delayed right now. I'm not looking at I don't trade off of TradingView, the direct connection to TradingView. So TradingView is making more and more advances with linking brokerages with this. I just have always thought it's a better charting software. And again, being more focused on Bitcoin, don't feel the need to get that data feed hooked up here. Not when you're already paying for it on Sierra charts and paying it through a prime broker to begin with. So you could use Sierra charts, you could use Trading Technologies. I've used both of them. I've been talking a lot about these lately, and I think that it is to your advantage because I think the market is moving in this direction as a whole, to be paying attention to more of these sophisticated pieces of software and interfaces to allow you to have more of a granular view of what's going on in the market. So at least I think that I'm observing that in the crypto market as a whole, it's moving away from the really basic rudimentary methods of analysis, which are very useful as well, but they're more useful in a trend following environment. They're not necessarily as useful in a lower time frame environment, in a more active trading environment. Okay, so, and that's not to rib on people who trade just pure price action, because you talk about guys like Trader SE, Trader XO, Cred. These guys are trading just on the charts. And these are people that I can honestly say, even as a person who operates an educational platform, are phenomenal resources. All right. So what we're looking at right here is potentially a bottoming, or we have market close, but we're looking for this to begin to put in some type of base. All right, we'll likely see a rally in the S&P. We're going to definitely see, I think, Bitcoin put on a much greater rally than the S&P puts on, because we know we have a bunch of people just waiting for permission to buy back into this market, because not everyone liquidated and put it right into their bank account, right? So, and the benefit that crypto has is that it's very easy to transact right from your USD right to any crypto you want, compared to transaction limitations in traditional assets. All right, so that's that. I think we're going to hopefully find some type of temporary base. Again, check out Phemex. They offer this now. They offer Bitcoin versus gold. Okay, perpetual contracts. You could use up to 100 times leverage, and I think the fact that they offer the modern, what we are advocating, digital gold, and the actual traditional risk-off asset on one platform is going to be fantastic. I think you're going to be able to take advantage of carry trades, different stat arb trades between these two. Whenever they start to form maybe potentially a stronger correlation, you'll be able to trade these correlations when there's a large dispersion between the assets, when they're really tight. Okay, we're talking about more stat arb type trades, things that are a little bit more advanced. But the fact that you could trade this when maybe this is going to potentially lead the market, okay, before Bitcoin does, on the same platform through the same USD, and you could again, this is a test net, but you can set up sub accounts so that you can take opposing positions. Now the thing that is great now is they also offer triggered trailing stops. Okay, this is great, because sometimes on some platforms, on most platforms actually, you could only put on a trailer stop. I'm spending too much time with my wife. She's working on the horse trailer. You could put on a trailing stop from the beginning. So what you have to either do is put it on manually, all right, after the fact, or you have to put it on from the beginning. And what this does is it trails the asset, all right, and as the asset moves up, it follows it by a certain amount. But then once the asset moves down, it stays where it is. Okay, so you could still be potentially prematurely stopped out, versus a triggered trailing stop, right? It only is going to be put on when a certain level is hit. So let's say that, for example, before this trade occurred, I could have not had the trailing stop on until this point. So maybe I wanted to make sure that I locked in the bulk of what I anticipated was going to be the move, but I don't want to take it off yet. I still want to let my idea ride, maybe to a certain degree. Maybe I'll take half the position off, and then I'll put a trailing stop on by, let's say, 1 ATR. So I might look at the current daily ATR, maybe more along the lines, because we're dealing with short-term trades. I'll look at the 1 hour ATR and I'll say, okay, the 1 hour ATR is $157. Maybe 0.5 ATR, multiple 0.5. So we're looking at, anywhere along the lines of $80 right now for that trailing stop distance. Okay, and then the market will only turn on whenever it reaches the price I have set. It'll only turn on that trailing stop at that point. Okay, which could have been my target, right? So that's that, guys. As always, all right, be sure to leave a comment, check out Phemex, use the link below. And if you're not familiar with BlockRoots, we have a fantastic educational platform. We have a link below for that as well. As far as anything else goes, stay safe, stay healthy, all right, stay indoors. Okay, exercise proper risk management and trade effectively. Cantering Clark out.